It is Friday morning, July 17th, 2026. The opening bell hasn't rung yet, and, well, the implied open is flashing red heavily.
Yeah, the structural damage is already showing.
Exactly. S&P 500 futures are currently trading down 1.09%, hovering right near that 7,495 mark. But the real stress test, the epicenter of this, is concentrated in tech.
Right, the Nasdaq.
Yeah, Nasdaq 100 futures are taking the absolute brunt of the overnight selling. They're tumbling 2.19% down to 28,584.25.
The load in the market has simply become overwhelming. We are tracking a massive macro collision that materialized during the overnight session.
And that brings us to the source material for today's deep dive. We've got a stack of raw institutional financial briefs, specifically the pre-market scripts and strategy notes from the Bulls, Bears, and the Bell Financial Desk.
Dense material.
Very. And the mission here is to act as your ultimate pre-market translator. We're going to parse through this data, decode that implied open, and extract the critical levels and catalysts you need to navigate today's price action.
Without getting lost in the jargon.
Right. Exactly. Okay, let's unpack this. The overall market sentiment is locked in this tight, neutral tug of war. But there is some serious pre-market selling gathering steam. We need to isolate the twin global catalysts driving this.
Starting with what the institutional notes are calling the tech reset.
Right. TSMC just announced a $100 billion U.S. capacity expansion plan.
Which is staggering.
It is, and historically, the market would cheer that kind of massive capital expenditure as a guaranteed sign of future growth. But today,
it is sparking intense Wall Street anxiety over AI overspending.
Because it comes down to a sudden, violent shift in how investors view return on investment. It's very much like renovating a house.
How so?
Well, for the past year, investors were absolutely thrilled when tech companies were drawing up plans to buy the premium materials, right? The high-end AI chips, the infrastructure.
Yeah.
But now, that $100 billion invoice from TSMC is sitting on the table.
And the market is panicking about the final cost. Exactly. Investors are looking at these massive capital outlays and questioning if the near-term consumer demand for AI can actually generate enough revenue to justify it.
So it's a timeline mismatch. I mean, TSMC building new capacity takes years to come online, but Wall Street demands quarter-over-quarter revenue growth right now.
Right.
And just as the market is choking on that AI overspending anxiety, the second force hits. A sudden, severe spike in geopolitical risk.
The Strait of Hormuz.
Yes. The notes highlight escalating U.S.-Iran hostilities in the region. We are seeing reports of a sixth consecutive night of U.S. airstrikes. And looking at this strictly as a factual market catalyst, keeping our lens entirely impartial, the math is undeniably rattling the energy corridor.
The creep spikes are immediate.
Yeah, WTI crude is up 1.2%, pushing to $79.86 a barrel. And Brent is nearing the $85 mark, sitting at $84.13.
If we connect this to the bigger picture, the convergence of these two forces is precisely what makes the pre-market volume so fragile. Energy inflation risks are instantly back on the table.
Which drives up input costs globally.
Right at the exact moment tech valuations are facing intense scrutiny over their infrastructure bills. Momentum has officially shifted from buy the dip to sell the rip.
So it's like driving a car where the engine is suddenly overheating from AI spending right as you enter a geopolitical minefield.
That is a perfect analogy.
Let's translate this global anxiety into the mathematical realities of the futures market right now. We have S&P futures near 7,495 and Nasdaq futures at 28,584. Give us the exact line in the sand support levels for the day.
Okay, for the S&P 500, the line in the sand is a psychological 7,500. We are testing the underside of it right now.
And if it failed?
If buyers fail to reclaim and hold 7,500, the trapdoor opens to a rapid flush down to the 7,450 to 7,460 zone.
Wow. But the Nasdaq 100 is where the real bloodbath is, right? I mean, the 2.19% drop in the overnight session is brutal.
The critical floor for the Nasdaq is 28,500. Sitting near 28,584, we are dangerously close to it. If that level is breached, it drops clean to 28,300.
So if you were looking at your screen right now and thinking this looks like a classic gap-and-go scenario where you step in and buy the morning bounce, is this a buying opportunity?
Absolutely not. The institutional strategy notes are aggressively warning you not to catch a falling knife in semiconductors this morning.
Because it's a trap, right?
Exactly. It is a crowded trade liquidity trap. Retail and institutional buyers who bought the early AI dip are now trapped in underwater positions.
So any early bounces we see off the open?
They are just being sold into by institutional desks using that temporary retail demand as exit liquidity.
Keep your position sizes incredibly small today, folks. Okay, so we've established the broad market breakdown. Let's drill down into the specific pre-market gappers, the companies dragging the Nasdaq down.
Netflix is a fascinating one here.
Ticker NFLX, yeah, tumbling 9.2% pre-market. It is trading down to roughly $68 after closing at $74.35 yesterday. And if you only looked at their Q2 performance, you'd be utterly confused by this.
Right, because they actually posted a Q2 beat.
Yeah, a slight beat, but still. EPS came in at 80 cents versus the 79 cents expected. Revenue was $12.56 billion. But the stock is tanking. Break down the why here.
It is a brutal masterclass in forward guidance, overriding past performance. Q3 guidance was soft. They forecast revenue of $12.86 billion, which misses the $13 billion consensus.
But the revenue miss is almost secondary, isn't it?
It is. The real trigger for the drop is that Netflix is reducing its highly scrutinized viewership hours report. They are moving it from a biannual release to an annual release.
And markets despise a sudden lack of visibility.
Especially from a company whose valuation relies on constant growth. When management reduces visibility into user engagement, analysts assume engagement is plateauing and management is trying to hide it.
The narrative fundamentally shifts back to a mature media giant relying on price hikes, not rapid organic growth. Watch the $70 bear case level today. That's the 200-week moving average.
And we are seeing that exact same aggressive growth valuation reset play out with Intuitive Surgical.
Ticker ISRG. Plunging 10.9% pre-market to roughly $358. Just like Netflix, textbook Q2, massive beat.
Right.
Adjusted EPS of $2.80 versus $2.51 expected. So why the plunge?
Because it was priced for perfection. Their full-year procedure growth guidance of 13.5 to 15.5% just wasn't enough to justify its rich valuation.
Ah, and then there's the recall.
Exactly. It's complicated by a Class 2 recall on system components. When you trade at an extreme premium, a component recall is the exact excuse portfolio managers need to aggressively de-risk.
So what does this all mean? In this market, record profits and standard beats are just no longer enough. The market is demanding absolute perfection.
Which means capital is fleeing tech. But it doesn't just vanish. It has to go somewhere.
Right, sector rotation. Where is the institutional flow pointing?
They are rotating into defensive and hard assets. Energy, tracked by the ETF ticker XLE, is the tactical winner.
Driven entirely by that geopolitical crude spike we talked about.
Yes. But industrials, tracked by ticker XLI, that is the structural winner. Despite housing contractions, industrial production remains incredibly resilient, actually hitting a 5-year sentiment high.
And Abbott Laboratories is the ultimate proof of this resilience on the board today. Ticker ABT. They broke out 10.71% yesterday, closing at $98.83.
They blew past expectations and actually raised their full-year EPS guidance to a range of $5.45 to $5.60.
Because their electrophysiology and diabetes care divisions are expanding so fast. Right?
Exactly. It's completely offsetting the infant nutrition softness. Bulls are looking for a break above $100 to run toward a fair value of $118.64.
Okay, to truly grasp the risk profile of this Friday morning, we have to look underneath the stock market. The fundamental plumbing.
Yields and the dollar.
Let's drop the real-time data. The U.S. 10-year Treasury yield is sitting at 4.54%. And the U.S. dollar index, the DXY, is hovering near 100.69, which is actually down 0.3% weekly due to soft CPI and PPI data. Now, with yields slightly easing, shouldn't that be a tailwind for these struggling tech stocks?
Well, what's fascinating here is that the tailwind is severely capped. The geopolitical floor under the dollar is neutralizing it. Safe haven buying due to the Middle East tensions is overriding domestic inflation data.
Which sets up a massive trap for retail investors.
The looming pain trade. Retail's heavily long on high-beta tech and simultaneously long on long-duration treasury ETFs like TLT.
Assuming soft domestic data means falling yields.
Exactly. But they are blind to the rising term premium and geopolitical supply shocks. If deficits and Middle East tensions force the 10-year yield back up toward 4.65% or higher,
retail portfolios get crushed on both ends simultaneously. The bonds tank and the tech stocks tank.
The ultimate pain trade.
Wow. All right, let's synthesize this deep dive before the bell rings. The AI valuation reset is here. Perfection is the new baseline for tech earnings. Capital is aggressively hiding in industrials and energy, and everyone needs to keep a very close eye on that 10-year Treasury yield.
And there is one final unexplored thread from the source notes to leave you with.
Oh, right. The tariff.
Yeah. We've spent all this time talking about AI CapEx and Middle East oil shocks, But the institutional notes also mention a sudden 25% White House tariff on Brazilian imports that just spooked global supply chains.
And keeping our strict political neutrality here purely as a market catalyst, that is a massive supply chain friction point.
Exactly. As you watch the market open today, ask yourself, are we so distracted by the tech crash that we are completely ignoring a brand new wave of global tariff-driven inflation?
It's the variable hiding in plain sight. Thank you for joining this deep dive into the pre-market data. You have the levels, you have the catalysts. Keep your position sizes small today and stay disciplined out there.